Okay, folks, welcome to Best Stock Charts for the coming week. Before I get into the charts, I want to make an announcement to members. Members, I'm going to be doing an additional member stock chart request this weekend, so please go to the members area, enter your symbols on the ticker cloud, and I will review your stocks on video this weekend. So please take advantage of that. Now, before I go into where I think the markets are going to head in the coming week and weeks, let's first take a look at the announcement that was made after the close on Friday. The Atlanta Federal Reserve, this is an image off of Twitter, or a tweet off of Twitter, where they announced that the Atlanta Federal Reserve lowers its GDP forecast to 0.6%. They did this on a Friday afternoon after the market was closed ahead of a 3-day weekend. They used the word nefarious in their initial post, and the ironic part is the fact that they used this news dump as a way for the markets to absorb the data over a 3-day weekend to avoid a reaction is simply nefarious. But this is typical of what we should expect out of the Federal Reserve. Now think about it. 0.6% growth in the fourth quarter. This is after trillions of dollars of quantitative easing, QE, and this is the best that we get, 0.6% growth. And if they're admitting to 0.6% growth, we're probably in negative territory. Now, Janet Yellen was interviewed a few days ago and was quizzed on the weakness in the market and how she would respond if, after a rate hike, the markets fell apart as they're doing right now. And her reply was that she, quote unquote, she would go back and do what worked before, meaning more QE. Think about this. She actually thinks it worked. That's how delusional Janet Yellen is. And when you take a look at the chart of the S&P 500, you could see how, this is a daily chart, you could see how the markets are waiting for an action, an announcement out of the Federal Reserve. And I've been warning members about this for quite some time, which is why I do not want to go adding to shorts on weakness. It's because I expect some announcement, a speech. This rally on the 14th was due to Jim Bullard, one of the Fed governors, coming out and making a statement that got the markets all happy that, you know what, perhaps there's going to be some intervention by the Federal Reserve in the markets. And sure enough, we got a rally. It only lasted a day because traders that are out there knew that it was way too soon for the Federal Reserve to act, and they took the market down once again on Friday. Now, trust me, they want you to believe that this is all to do with China. They want you to believe that this is all to do with the North Koreans testing a nuclear weapon again, as if that's something new. Folks, this has all to do with the failure of the Federal Reserve. It has all to do with the failure of the U.S. federal government's inability to institute a tax code and growth strategy to get this economy moving. The over-reliance on the Federal Reserve has caused what we're going through right now, and it's only going to get worse. If you go to my 2016, the year ahead forecast, you can even go back to my 2015 year ahead forecast. Just go to the search bar at thecontrariantrader.com, type in forecast, and both will pop up. I have been predicting this sell-off for months now, and sure enough, here we have it. So let's get to the charts, and let's try to talk about opportunity, a strategy. And members, I'll be going over our in-depth strategy of how we're going to trade these markets on the week ahead commentary, which I'm going to begin immediately after I complete best stock charts. And on that video, we're going to discuss the overall averages. Where are they now? Are they poised for a bounce? Are they set to decline further? What sectors are looking good? What charts are really setting up nicely? And those charts will include the charts I'm going over on best stock charts, but in greater detail. That'll be going out to members. So members, stay tuned. That'll come out on Sunday. And we'll go over your members stock chart requests as well. So again, please, reminder, enter those symbols on the ticker cloud. All right, so before we leave the S&P 500, what is going to be the reaction of the market due to the Federal Reserve announcement after hours on Friday? My guess is that it's not going to be good, and that the trend will continue because there's no other reason for it not to continue. The worst thing that could have happened in the past several days were these relief rallies, because it only sets us up for more of a sustainable downtrend. Had we not had these rallies and went straight down, you would have had an unsustainable downtrend. So this alleviation of this sell-off only sets you up for a further downward move. So I think the path of least resistance, after slicing right through these support levels like a hot knife through butter, is to the downside. And I even mentioned on Thursday's morning update, which is posted on the blog, that I predicted that we would take out the September lows and in all probability the August lows, and we did that. We did bounce, but I don't think that we're going to hold these support levels. I think we're going to break further. Now, for those of you who are new to charting and you believe that you're seeing a bottoming tail here or buyers below come in, I'm going to caution you. A lot of this is short covering ahead of the weekend. So you had buyers come in and bid the shares back up on the S&P 500. Now, there's a saying I like to use that today's lows could be tomorrow's highs, meaning take a look at the price action during this sell-off, especially back in August as well, even more so back then. This day's lows on the 20th of August were the highs of the 21st. Same thing goes here. So don't go trying to catch a falling knife, because the path of least resistance is to the downside. There's going to be a buying opportunity of a lifetime soon. Believe me, I am optimistic as hell right now. Why is that? It's because we're trading smart to the long side and we have a short position in the market. So we did very, very well last week because we saw this coming, and you need to learn how to read the charts. If you're relying upon CNBC, if you're relying upon some pundit whose vested interest is to see the markets move higher, then you're going to lose money. If you believe that this looks oversold, don't kid yourself. It can get worse. Simply take a look at the RSI. It continues to roll over. This is what prompts me to believe that this selling is not done yet. Could they rally it, try to take back 1900? Sure. It's not going to last. We're going lower. So I mentioned our performance last week. Let's get to it. How did we do last week? We did very, very well because of our trade in Netflix. And actually, if you go over to my 2016, the year ahead forecast, one of my regretful trades of last year was the third trade that I made on Netflix in 2015, which turned out to be a loss. And it's because I didn't obey a discipline. And that was acknowledging that this breakout was for real. So far in 2016, we are way up on Netflix. And that doesn't mean that I haven't taken a loss. I did last week. And the funny part is that we were long here on the 12th. It was the first time I carried Netflix shares long overnight. And in doing my analysis the evening of the 12th, I always like to do my analysis at night. The markets are closed. You can't do any type of impulse buying or selling. You're able to establish a strategy for the next trading day or week. And on this particular day, the market had closed fairly strong. Yet Netflix, which has been a market outperformer for a long time now, couldn't close above its 50-day moving average. And here's what I told members. The reason why I am not excited about it is the fact that it couldn't close above its 50-day moving average. The market rallied back. Netflix has been an outperformer relative to the overall market, and it couldn't rally through its 50-day moving average. It really ticked me off. So I held on to shares, but if we break down below 115, I'm getting out. Ideally, they spike it higher because we did break out today below this secondary downtrend line. Hopefully they gap it higher, right up and through 122.18. But I just don't like this price action. I also don't like the volume. Volume came in lower today than it did yesterday. I'm not loving the chart. something is just bothering me. I wouldn't be a bit surprised if they came out with a downgrade, an earnings warning, something tomorrow morning to take the stock down. I just have that feeling in my bones. I can't explain it. It's just what you learn after all these years of trading. When you see this kind of price action, this is a stock that should have rallied strong into the close. It didn't. And that's what bothers me. So we'll see what happens tomorrow morning. We'll see what the markets have in store for us. So you could see that on the 12th, I knew that the next day I was going to get clubbed like a baby seal. I was going to get stopped out of this trade. So did I need to wait for the market to open and to hope that I wouldn't get stopped out? No. All I did was this. I realized that in all probability, and technical analysis is all about probabilities, that in all probability I was going to get stopped out of my trade. I set my computer up, set my stop loss, and let the computer do the work. It takes the emotion out. It takes the hope out, because if you're hoping when you should fear, you're going to get hurt. And I also set my computer up to get short of Netflix. And we captured this move down from the 13th through the 14th down. The vast majority of this sell-off, not on the 15th. We were already out. So we made up for our loss here, plus some, to the short side. And this is the value of learning the charts. If this breakout, note how we had a breakout on the 12th. And don't think that I didn't realize that. I mentioned it on the video that we had broken out. But I was still bearish on the next day because I figured that what this was, given the health of the overall markets, was a bull trap, or as I like to call it, a breakout point failure. What is that? A breakout point failure is when you break through resistance and close there, but the following day you are unable to hold that breakout point. And if you are unable to hold that breakout point, in all probability, you are going to retest the lower band of resistance. And there's a very, very high probability, especially when the markets are falling apart, that you will break down and close below this lower band of support. That's why it was a no-brainer to get short. So while, yes, it stunk that I lost money to the long side, but it was also a good thing because I knew that this breakout point failure was going to bring substantially more profits to the downside because Netflix was falling apart. The market sent me a signal. And I took the cue. We made money to the downside. We didn't cry. We didn't go get all sad that we took a loss. That's part of the business. That is part of the business. Knowing how to keep your losses small and then letting your winning trades run. Now, if you're a day trader, I can't help you. I am not a good day trader. Not many people are good day traders, especially now with high-frequency trading. I can't do it. I wasn't good at it back in the late 90s. I'm not good at it today. I am a swing trader, a multi-day trader, a multi-week trader. And I'm not knocking day traders. If you're good at it, God bless you. I have a lot of respect for you. We all have to be honest with ourselves, what our strengths and weaknesses are. And mine is not rapid-fire day trading. Simply not. I am more of a strategist. I like to set up strategies and execute, build positions and execute. And of course, focus on money management. So Netflix, a really nice trade this week. And you may be asking why, if you have the courage of your convictions that the stock is going lower, why are you not still short of Netflix? It's because they report earnings soon. I do not want to be long or short of any stock into earnings. Unless, of course, they are at an extreme overbought level where I'll short it ahead of earnings on spec, or at extreme oversold levels where I'll buy it on speculation that it won't go down any further. So Netflix is a watch to me right now. Chipotle Mexican Grill, CMG. Everybody hates it. We were buying it here. We were buying it using the 410 call options out to February. Now, I did not capture this entire move higher, but I did capture this move higher, and we made 35% in a couple of trading days on this trade to the upside. Now, you may be asking, why didn't I hold on? It's because I have a rule. And that rule is that if you're trading front month contracts, which the February's are now front month contracts, you want to get in, you want to get out. Don't risk losing your profits. Also, on the 13th, it appeared as though, and I was right about the markets rolling over, late day on the 13th, CMG was beginning to weaken. Our stop loss was triggered, and we were taken out of the stock. Again, we didn't need to sit there and watch and wait and see if CMG was going to rally or was going to roll over. All I cared about was making sure I didn't lose my profit. So we set our stop loss order. It was triggered. The stock continued higher. Oh, well, am I going to cry about making 35% of my money in a week? No. So CMG, great trade. And don't forget, these are positions that I booked profits on. We are still short of the market, in particular the Dow Jones Industrial Average. To me, it's too late to get short of the Dow Jones. It's too late to get short of the Russell 2000 from a risk-to-reward perspective. It doesn't mean that because I believe it's too late that the names like TZA, and I'll start off with the TZA because I'm watching it, it doesn't mean that they can't head higher. Hell, I was stopped out back here in early January because I had a trailing stop loss order put in, and the TZA continued higher. Does it mean that it can't continue higher? Sure it can. But I'm telling you right now, these charts, this bearish key reversal and this hollow candlestick is telling me that the rally in the TZA is, if not at a top, very, very close to a top. So if you get the opportunity to sell into strength on the TZA, if you're currently long, I would at least take half my position off the table, use a trailing stop loss order. Don't lose your profits. Am I going to cry that I didn't capture the top on the TZA? No. We had the foresight to be short of the Russell 2000 at the beginning of the year, and I am looking to get back involved with the TZA on a pullback. So TZA is on our watch list. We will be looking to buy it back on a pullback, and trust me, folks, there is going to be a pullback because this market is going to rally in the next week or so. And I don't mean a one-day rally. I'm talking about a counter-trend rally. And counter-trend rallies during a bear market are very, very vicious to the upside. So, members, we'll talk about that more in greater detail on the week ahead commentary. So, TZA short-term, to wrap this up, I think is going to pull back. We'll look to get long on a pullback because I do not believe that this sell-off is over by a long shot. All right, more names we're looking to get long of in the coming trading days. TNA. This is the leveraged bull ETF on the Russell 2000. I am going to be looking to lever up, meaning get very, very long of the TNA in the next couple of trading days. Why is that? It's because while I believe that there is still some pressure to be put on the TNA, I think we're very, very close to a bottom. Ideally, we get RSI below 20, but that may not happen. And if it does happen, you could bet I'll be levering up all the more, getting very, very overweight of the TNA. But folks, it's critical. During a market period like this especially, is that it doesn't matter where a stock trades intraday. What matters is where it closes. So if you're sitting there at lunchtime watching your stocks and trying to bet that it's a bottom, trust me, you're going to lose. Wall Streeters know exactly what you're doing. You're at your screen. You're hoping to pick a bottom at the wrong time of the day. They trade 2 hours of the day. They set their positions up in the first hour of the trading day and in the last hour of the trading day. All the rest of the trading that goes on intraday is computers trading with computers and you getting suckered into bad bets. Don't get suckered into bad bets. Watch and wait and see how the market closes. So TNA is on our watch list. Yes, we had a reversal off the lows of the day, but still we were down 5% on the day. We can go lower. And it's just when you think the market can't go lower, that's when it goes lower in a bear market. Trust me, I've been through many, many bear markets. You'll know when the market is done going down and you need to wake up. You need to see the futures markets down very, very big, and then you get a reversal day. That's your bottom. Not yet. It's not here yet. Next chart up, BOKF, BOK Financial Corp. I'm going to go over all weekly charts because all of these symbols that I'm going to go over, with the exception of WellCare Group, which I believe to be a short, and as well as JB Hunt later on in this video, I believe those are still shorts. But the names I'm going to go over right now are all on a daily basis at extreme oversold territories. Now it's just a matter of timing. When is the appropriate time to get long? Because all of them look good. Now, we're going to go over the weekly charts because if you're looking at a daily chart to time your buys, you're going to lose money because weak stocks tend to get weaker. Before we go into where our support levels are on these names that might hold, not definitely, but might hold, we're going to take a look at where the market sent us signals to get out and the value of charts. And in this case here, BOKF on a weekly basis broke out the week of November the 2nd. The following week, it broke back down, and this was your signal to get out. This was a breakout point failure. This was a bull trap. And had you heeded the warning that the market sent you, it sent you a signal. You can complain that the market is rigged all day long, but this was fact. This was published to everybody that was willing to look and pay attention to the charts. The market told you to get out, especially when we broke down below 69.94, which was a confirmation breakdown, and you would have avoided this sell-off. What a great short. And take note of RSI, where we broke out the week of November the 2nd, yet RSI was putting in lower highs. Very, very bearish stuff. Where is the support level that might hold? And why am I saying might so much? Well, this was a pretty good support level. There was no defense. This was a fairly good support level. There was no defense. This might be a good support level down here. We bounced off of it last week, but we need to take a look at the daily chart and time those buys right. So the probability of these support levels holding are fairly good, but you need to time your buys along with the daily charts and the intraday charts. And folks, if you're day trading, you're going to lose money. You need to position yourself properly, and you need to do your analysis after the markets have closed. Next chart up, CFR, weekly chart. Another one where the market sent you a signal. Lower high put in. Prior high $79 per share, lower high $78.94. Here was your key support level. The week of September the 7th, it broke. You had to get out. You would have avoided this sell-off. And if you bought up here, and even up here, you may have said, my God, I have to stop out and take this loss. If you took the loss back here, think about how good you would have felt looking back now about how wise you were to take that loss. Folks, everything is about capital preservation right now. And what appears to be a good support level, they're getting snapped in two. And this is what happens during a stock market correction and the beginning of a bear market. And you can see this support level last seen back in 2012 looked like a really good support level before we got down there. And then all of a sudden, we broke right through it like a hot knife through butter. Now maybe, just maybe, the 44.50 level might hold. So we'll be eyeballing that. And we'll, in addition to eyeballing that support level, we'll be paying attention to the daily and intraday charts for a signal that the stock is done going down. Members, again, we're going to be going over all of these charts on a daily basis and an intraday basis on the week ahead commentary and market wrap on Tuesday. The markets are closed Monday. Next chart up, ECPG, monthly chart. I had to go back that far to find historic support. And you can see that the market sent you signals multiple times on ECPG to get out. Why is that? Stocks have their own personalities. And on RSI, which I love to use, one of my favorite indicators, RSI typically puts in a double top on ECPG. It did so back here in 2003, did so back here in 2010, did so back here in 2011, and it just did it again in 2013 when we went into this pennant formation. Now, the key with pennant formations is to appreciate the fact that if you get a breakout, the stock is probably going to go a lot higher. If we break down, the stock is probably going to go a lot lower. It's one of those formations that you must know if you're going to use the charts. And the minute you break down, you got to get out. That's the discipline. You keep your losses small. Now, note how we sliced right through this key support level like a hot knife through butter. Now, we might hold 1670 to 1471. That's a pretty wide spread. So we need to, again, pay attention to the daily and intraday charts to time our buys right. So ECPG will be looking to get long of. SRPT weekly chart. Another stock we want to get long of, but not quite yet. Clearly, putting in lower highs in RSI, lower highs on price. Once we broke down below this support level, you had to get out. If you did so, you would have avoided this huge sell-off. A 50% haircut. And in all probability, we're going considerably lower in the coming trading days. And we'll be looking at $12.50 to $11 per share as our support level. And then revert to the daily and intraday charts to time our opening position with SRPT. And when I say opening position, that means that we begin to accumulate a position, not jump in with both feet. If you do that, meaning jump in with both feet, you're going to lose your shirt. You need to build a position. Nimble, NMBL. I've gone over this one several times. This is a daily chart. The reason why I'm going over a daily chart is because there's no historical support below. So you need to use your daily charts and intraday charts. Now, this looked like good consolidation last week. However, RSI was still too high for me because we know from experience that once you get down into the single digits on RSI, especially during a bear market, you can get single digit RSI. So the price action wasn't enough. RSI wasn't confirming that the all clear was being signaled to get long of Nimble. Sure enough, on Friday, we broke down and we flashed a bearish key reversal, meaning they tried to rally it. It failed, closed near the lows of the day. That means we're going lower on NMBL in the short term and probably considerably lower. So while I like NMBL and I've liked it for quite some time as a watch and a potential long, the markets haven't sent us a signal that it's time to buy, and in all probability, it's going lower. Folks, avoid the name right now. Would I short it? No, because I'm not that big of a short-term trader. While you could day trade it to the short side, sure, not my style. You need to get out quickly because it can reverse, and on that reversal, you want to get long. Next chart up, SAM, Boston Beer Company. This is a clear head and shoulder setup, left shoulder, head, right shoulder. Here's your neckline. If you didn't pay attention to this breakdown below key support, you had to pay attention to this. This stock, folks, is going lower. Maybe not in the next couple of trading days. It may bounce, and we'll be looking to get long of the name. But right now, the path of least resistance remains to the downside, and I'll be looking to get long in the next couple of trading days. Why? All of these stocks have a particular catalyst that will propel the stock higher very, very viciously. It could be a short squeeze. It could be dividend play. It could be the fact that it's undervalued. But all of them have a catalyst, and I'll go over those catalysts with members on the week ahead commentary. Now note, if you're looking for support on these charts, they are not being defended. Prior support back in July of 2013 failed to hold. My guess is that at a bare minimum is that we are going to come in and retest the April to June lows of 2013 on Saem. So the path of least resistance remains to the downside. Big, big down volume. This is institutional distribution, not mom and pop selling 100 shares. You as an individual investor and me, we don't stand a chance against these guys. Do not fight them. Avoid fighting with these guys. If you duel with them, they'll take out your account. It'll get blown up. Express Scripts, weekly chart. Another head and shoulders setup. Left shoulder, head, right shoulder. Here's a long-term lower band of the rising uptrend channel, broken. And here was a signal by the market back in August when it really sold off hard and then rallied back and put in that lower high. The prior high was 94.61. New lower high was 88.20. So you really had to have your antenna up if you were long of the name and use your stop loss, use a stock charts, get your crayon out, draw a line. Once it closes below this lower band of support, you got to get out. The pain may hurt by taking that small loss, but take a look back now. If you would have stopped out back here, had you used your stop loss order, had you used the stock charts to get out of the name, because the markets sent you a signal. Autonation weekly chart. I mentioned this one a couple of weeks ago. It was breaking down. It would probably go further down, but we still like it as a potential long trade. And when did the market tell you to get out? Well, the series of lower highs should have told you that it wasn't time to buy. Then when we pulled back in August and rallied back higher, you needed to draw your trend line. And the failure here, the week of November the 2nd, to break out in this topping tail, should have had you at least lightening up on your position. And when we broke down below this lower band of the rising uptrend channel, which began in August of 15, you had to get out. And the failure the next couple of weeks for the stock to recapture that support level gave you an opportunity to get out again. And then you find yourself where we are right now. Weak stocks tend to get weaker, folks. So when you see these breakdowns, the strength is gone. They're now underperforming the overall market. Or if they were an outperformer and are now trading with the market, that means they're losing momentum. So you need to look to the short side to profit. So on a daily basis, on a short-term basis, all of these charts I'm going over are looking good to the long side as a short-term swing trade. I don't believe that these stocks are heading back to all-time highs anytime soon. Trust me when I tell you. But are they poised for a short-term rally? Yes, they're setting up nicely. A lot of opportunity out there. But you need your cash to play. Virgin America weekly chart. Not enough data on this chart to really give us a clue of what might hold. So we'll deal with the cards that we have to deal with. I mean, the stock has only been public since late 2014. So you can see that we're nearing support at 27.95. I don't think this is going to hold. I think we're going to go down lower to this support level here, to the July lows. So I think a low is getting put in on Virgin America. We'll go to the daily charts with members. We'll discuss the best risk-to-reward entry point on Virgin America. We are trading down below the third standard deviation Bollinger Band on a weekly basis, but that doesn't mean that it's a buy. Now, if you had RSI trading down below 20 on a weekly basis and the share price trading below the lower band of the Bollingers at a support level, well then, that would be a buy. But we're not there yet. The stars are not in alignment quite yet, folks. So what looks like a bargain right now isn't. It could be a bull trap. Don't get lured in yet. It's not yet. There is blood in the streets, but there is not enough blood in the streets. This is a great unwind. A lot of margin debt out there needs to be unwound. A lot of institutions need to get out. Don't get suckered in. The first sign of a rally, they're going to sell that rally. American Axle. This is a cyclical play. Folks, cyclical plays get hammered like baby seals like you have no idea. I've traded this stock many, many times over my career, and it's probably going to go down eventually once again to the single digits. And it's been there through this cycle many, many times. Great company, but it's probably going lower. A huge head and shoulders setup, left shoulder, head, right shoulder. This, had you appreciated the fact that this is a cyclical, and once it starts going lower, there's no stopping it until the economic cycle reverses, the business cycle reverses, you had to get out. RSI was signaling lower highs, double top here, lower high, you had to get out. Draw your trend line. The minute that it broke that support level, you had to get out. You don't need to be sitting in front of your computers, folks, to make money in this market. That's probably the worst thing you could do is sit in front of your computer. Set your stop loss, take the emotion out of the trade, go to work, go to your day job. Let your computer do the job for you. We're that advanced of a society now. And if you're not familiar with how to do that, use the paper trading feature on your trading platform. Thinkorswim. They'll start you off with $100,000. Practice. Learn how to paper trade. Learn how to take the emotion out of trading. If you learn how to do that, you're a very powerful and effective trader. And believe me, the institutions do not want you to learn how to trade that way. God forbid you knew when to get out when they did. There goes their business. UWTI. All right, this is not an extreme trade right now. This is a daily chart. It's not done going down yet. If they rallied it on Tuesday, however, why would I be not surprised? It's because this is a morning star. This is a doji star formation. This is a sign by the markets that, if you're familiar with candlestick charting, that there is indecision in this commodity. Traders are unsure whether or not it will continue lower or will continue higher. So watch oil. Watch the US dollar, because the dollar has a direct impact on the price of oil. If the dollar goes higher, that means pressure on oil prices. If the dollar pulls back, that means that oil is not definitely going to go up, but it's more able to go up. And the reason why I say not definitely going to go up is because there's just so much supply of oil out there that sometimes when the dollar goes down, oil still goes down. So that's a divergence. That will eventually be corrected, but the divergence exists right now. You need to recognize it. That's what I teach members. So I'm not ready to buy UWTI yet, but fairly soon I think we'll be long of the name. And what a mother of a rally this is going to be. WellCare Group. I think this stock is a short, and in the early stages of a short, and I want to bring this to your attention for a reason. All the weekly charts I've gone over are charts of stocks that have really already begun their bear market correction. WCG is really just beginning, because here you had your bull trap, which is also the head of the head and shoulders setup. Left shoulder, head, bull trap, right shoulder, and here's your neckline. The week of January the 4th, we broke through it. Last week, we tried to recapture it. The failure of WCG to recapture the support level was a tell. And that tell was, it's going lower. I will bet you a nickel. That's how brave I am. I'm going to bet you a nickel that WCG is going to be lower substantially in the coming months. And what I usually like to call this for members, if you hear me reference this type of a breakdown, I usually like to call it a breakout point failure. Some call it a bull trap. I call it a breakout point failure. Seadrill. Another one that I have been watching for quite some time, and this was actually brought to my attention by a member, and it was back here. And I've been watching it ever since. It's just one of those names, low dollar, high volatility, that it's a good trading vehicle, and it was in a nice trading range for quite some time. And I mentioned back then, RSI was looking good. It broke out. If it pulled back and held the support level, you might see a rally. And even here, it broke out. What did we get? A bull trap. Just as I've been mentioning on the recent charts I've gone over today, a bull trap. Very, very bearish stuff. If you roll over and break back down into this trading range, you must get out, because in all probability, you are going to go back down to the lower band of support, and there's a very high chance that you are going to break down. And you can see that we held this time, rallied back, and then rolled right back over again, took out this key support level. There was no looking back. We're now trading back down to RSI below 20. Volume is still high. Big institutional distribution. And I think that we are going lower. By virtue of the fact that I'm talking about these names right now, doesn't mean that I think they're going up in the next couple of trading days. I think Seadrill in particular is rolling over. We're going to go down. But I think the end is near. GoPro. Everybody loved this stock. We were shorting it back here. And we got stopped out, I think around here. We got short up here, stopped out right here, and the stock just continued downward. But you have to obey your rules, right? You set your stop loss, you stick by it. Now, there's not a lot of historic data on GoPro. We'll talk about the daily chart. We are leaning into the third standard deviation Bollinger Band. We flashed a bearish key reversal on Friday. In all probability, we are going lower. Yes, we have RSI below 30. And if you read the books, Technical Analysis for Dummies, and all these stupid trading books out there, they give you a rule of thumb that you're supposed to buy a stock when RSI goes below 30. Well, Take a look at if you would have used that rule here. RSI went below 30 on January the 11th. The share price, let's go with its lowest price of the day, was $14.57. Suppose you were lucky enough to get in at the low of the day because you observed the fact that RSI went below 30. How would you feel right now? You are substantially lower. Don't use rules of thumb like these books opine. You need to use a mixture of, yes, the indicators. RSI is great, but you need to use it in conjunction with price action, with volume action, with historical support, with your stochastics, which are forward-looking indicators. And once you combine all of your charts, historical, daily, and intraday, along with your indicators, you become a very powerful trader. If you do not do that, you are at the mercy of the market, and you're going to lose money. You're going to blow up your account, especially during a bear market. A bear market really separates the men from the boys. In a bull market, anybody can make money. You just get long and let the market continue higher. If you don't realize that the bull market is over, well then, all of that greed that you enjoyed on the way up, or the hope of future profits to the upside, and you don't realize that it's time to fear rather than hope, and that greed is now turned to fear, and you lose a lot more money to the downside because fear is a far greater motivator, you're going to lose all your profits that took you years to build in only a matter of weeks to months. So respect the charts, respect the bear market, and that's exactly what we're in, folks. Do not listen to these talking heads on Wall Street. They use the 20% rule that the stock market, the S&P 500, the Dow Jones needs to be 20% or lower to be in a bear market. That's ridiculousness. We have had 75% of stocks trading down below the 50 and 200-day moving average since the end of 2015. They've been in a bear market. The only reason why this market hasn't been lower is because of the triple Qs, the FANG stocks, Facebook, Amazon, Netflix, Google. Those are the stocks that were keeping the market higher. That's over with. Now they're going to play catch up. JB Hunt. I posted a video about JB Hunt on my blog back in, it was either November, I believe it was November or December, early December, that I predicted that JB Hunt was a short. That was back here. And here you had it. A breakout point failure, a bull trap, and sure enough, here we find ourselves once again. I believe that we're going to rally on JB Hunt along with the market in the next couple of trading days. But folks, I believe that we are going a lot lower on JB Hunt. Just as I'm bearish in the early stages of a sell-off with WellCare, I am also bearish in the early stages with JB Hunt. Folks, if you're not currently a member, sign up for our 14-day free trial offer. Members, we are going to go over member stock chart request tomorrow, along with the week ahead commentary, where we will review the health of the overall markets as well as our positions and what our strategy is going to be as it relates to the charts that we went over. So please enter your symbols on the ticker cloud. I'll review your symbols tomorrow in advance of the new trading week. So you go into the next trading week prepared. And again, if you're not currently a member, sign up for our 14-day free trial offer. Also, if you want to get these videos in the future, enter your email address. We hate spam too. You will not be spammed. Everybody have a great weekend and have a profitable week. Be well.